Hi, my name is Bil Lako, Managing Director and Principal at Henssler Financial. At Henssler, we believe it's impossible to time the market. Life comes with many what-ifs, and no one knows exactly what the stock market will do in the short run. That's why we believe in eliminating speculation by sticking to a long-term plan. This is where our philosophy, the 10-year rule, comes into play. Our 10-year rule states that any money needed in the next 10 years should be invested in fixed income investments that match your liquidity needs. Any money not needed should be invested in high-quality stocks or mutual funds for growth. The reason we have our 10-year rule is that it gives you the opportunity to wait out a depressed market. We believe this to be a more effective method determining your appropriate allocation than simply plugging your age into a formula. Each and every client has a unique situation with unique needs. Our approach attempts to take all available information into account when determining the appropriate stock-bond mix. Normally, there's a 10% correction in the stock market every year. We generally see a 15% correction every 2 years and a 20% correction every 3 years. If your liquidity needs are accounted for, corrections like these should not be cause for panic. A market decline isn't necessarily a bad thing. In fact, it creates a prime opportunity to buy. The stock market is the one place in America where people want to pay full price or more. People want to sell when it's down and buy when it's high. This is a counterintuitive method when it comes to your investments. The people who end up making the biggest financial mistakes are the ones who stray from the plan they've put in place due to fear. If you continue to dollar cost average during these down markets, you're likely to capture some lows, thereby lowering your average price per share. That's a good thing. When the stock market is rolling along nicely and everything is rosy for investors, following the 10-year rule is pretty easy. So how do you handle the transition from stocks to bonds in poor market conditions? It's a good question. Well, this is the heart of our 10-year rule. We essentially do nothing in down markets. That's right, nothing. We are not forced into selling in down markets because we've built in a time buffer and can afford to wait out the market. If you have the flexibility and won't need the money out of your portfolio in the next 10 years, there's no better place to invest it in stocks or real estate. The difference between the two being that stocks are completely liquid. While you can't sell one of your rental properties tomorrow, you can sell your shares in Pepsi today. Time takes care of you as much as picking the right investments will. Remember, stock prices can and will change, but if you have the flexibility to wait, the value of your shares should return and often be even better than before. The reason we employ our 10-year rule is fairly simple. In history, there have been 83 rolling periods of 10 years since 1925. Within those 83 periods, there have only been 2 10-year periods of time where if you'd thrown all your money in the stock market at the beginning and pulled it out at the end, you could have lost money. That's a 98% probability that once invested in stocks, you will not lose money in 10 years. That's pretty good. If you want 100%, invest for 11 years. Remember though, past performance is no guarantee of future results. However, my advice will always be, when there are disruptions in the stock market, don't watch it, don't open your envelope, don't look online. If you don't need the money within the next 10 years, stick with your plan. Our clients know they will have 10 years of uninterrupted income provided by the fixed income portion of their portfolio. Once the market recovers, guess what? We'll then begin to replenish the money withdrawn from the fixed income side. This plan, brilliant in its simplicity, goes to great lengths in reducing investor anxiety. My name is Bil Lako. Thank you for watching.